Alright, so let's begin the show. In the world of investments, asset allocation is key to minimizing risk and maximizing returns of your portfolio. But what exactly is asset allocation? How should investors decide their asset allocation strategies? Let's understand all this with Mr. Swarup Mohanty, CEO Director, Mirae Asset Investment Managers, and Arun Kumar, Head of Research, FundsIndia. Good evening and welcome to the show, Arun. First, coming to you because one really needs to understand in layman terms what exactly this is the concept of asset allocation.
Yeah, so broadly in very simple terms, asset allocation is essentially that if you have rupees 100 to be invested, you take a call saying how much of that 100 rupees goes into equity, how much of that 100 rupees goes into debt. So broadly, these are the two starting points. And obviously you can add other asset classes like say gold or say real estate. So, and obviously cash is used as an asset class globally. But again, for all practical purposes, these four are more or less more than enough for you to build an asset allocation model. So overall, the idea is how do you split your 100 rupees into these four different asset classes? Now, especially on the mutual fund side, broadly it is equity, debt, and gold. But real estate, as we all know, obviously we have some allocation towards it. Now, whether you consider it as a part of your financial portfolio or not, it's a different question. But broadly, on all simple terms, equity, debt, and gold is a good starting point.
But Swarup, talking about diversification, how important it is for you to be well diversified across asset classes?
I think like Arun said, you try to put your money across different asset classes. The fact remains that every asset class has its own merit, has its own behavior, and the performance of each asset class over a period of time can be very cyclical. So if you're caught in one asset class, more often than not, it goes through its ups and downs. And when you need money, and that day, if that was the downside of that asset class here, you might be caught on the wrong side. So when you allocate or you invest, there are two sides to your investing. One is the return that you want, and the second is the risk you are willing to take. Asset allocation actually merges both of them and gives you a good mix across different types of assets, like Arun rightly said, equity, debt, gold, cash. Some people look at real estate. And the proportion with which you allocate it to catch a kind of a balanced return on your overall portfolio, allocation across asset classes becomes very, very important. The key is the mix too. What you put or how much you put where will depend on your goal and the kind of risk that you're willing to take. The mix of both will give you an asset allocation grid.
Exactly. So a lot of planning and homework needs to be done from the investor's point of view also. But then Arun, how do you determine the appropriate asset allocation for a client? Because that is a very important exercise that one needs to follow.
Yeah, so broadly, if let's keep it really simple and look at only two asset classes like equity and gold. Equity and debt, and obviously you can extrapolate this framework to accommodate other asset classes, but just for our understanding. So the way we try to build an asset allocation portfolio is we call it the 3T framework, which is like the first T is essentially your time. So ideally, you have two different asset classes, which is equity, at least historically, has done well over the long run compared to your fixed income or debt. And again, the caveat or the catch is that in the shorter run, inevitably, you'll always have a temporary decline happening. Almost every year, if you look at Indian markets, you have a 10 to 20% kind of a decline. It's almost like a given. And once every 7-10 years, roughly, going by history, you should mentally be okay with a 30 to 60% kind of a fall. This is what has happened in the last 40 years. So more or less, at least the base expectation should be this. Now, the unfortunate part is that we do not know when that 10 to 20%, at least we know that it will happen every year, but we have no idea when is that 10 to 20% fall going to get converted into a 30 to 60%. So this is the balance of this asset class. Now, a lot of us can't handle it, so we want to curtail this temporary decline. So you add a debt which is far more stable. But again, the trade-off here is that over long periods of time, your returns from debt is more or less, say, inflation plus 1%, while on the equity side, you can probably expect inflation plus 5 to 7%. And good fund managers are able to do a far better job over and above this. But broadly, this is the way you look at it. So the longer the time frame you have, you can accommodate more exposure to equities. So the first leg would be to look at the time frame. Anything longer than 5 years, you can accommodate equity. And the longer the time frame, you can accommodate more equity. So the second leg is the tolerance to declines. As I told you, like pure equity is 10-20% almost every year, and then 30 to 60% once every 7-10 years. So net, this is not something which a lot of us can tolerate. So you add more of debt. So let's say you put 30% of debt and make it 70% of equity. The same tolerance band probably comes to 15% of a temporary fall every year. And then the longer once in a 7-10 year kind of a major fall is reduced to the 35% vis-a-vis the 50% for pure equity. Then again, if you put 50-50, you will again reduce it to say 10% regular falls and say a 25% once in 7-10 year fall. So this is the trade-off you make. So the more you add debt, the shorter you bring that temporary fall number to. The third leg is the trade-off. Now, then obviously, if you show only the second part, then people will say, hey, I'll put almost a lot of money in debt and then reduce my temporary declines. But the caveat is that there's a trade-off on the longer run. Say somebody at 12% returns is probably doing 10x in 20 years, right? If mathematically. And if you're doing at 10%, then it's almost 7x in 20 years. And then at 8%, you are at 5x in 20 years. So the more the debt you add, your returns are also coming down, and there's a trade-off on the longer term return. So as an investor, you have to say, what's my time frame? What is the near-term declines that I am okay to tolerate? And for that declines, the more the debt I add, I also have a trade-off in terms of my long-term returns. Now, based on all these three, broadly, you can come to an asset allocation. For most of our investors, we either go by 70 equity, 30 debt, or 50 equity, 50 debt, or 30 equity, 70 debt. Again, different investors will have a different combination based on how they look at these three T's. So that's how we come up with a broad asset allocation starting point.
All right, this is a broad asset allocation strategy, but then Swarup, this also means that rebalancing becomes very important in this process?
Kavita, I think you've stressed upon a very important part of investing, that is the rebalance. A rebalance comes post a review of the investment portfolio. I suppose let's take an example of what Arun is saying. Suppose the portfolio is 70-30. Now, first, between you and your planner, you fix up a periodic review time, say 1 year, 2 year, 3 year, that is between you and your planner. Now, suppose it is 1 year, just for simplicity. Now, 70-30 should be your equity debt portfolio, and the markets have run up and your equity has become higher, say by 10%, or depends on whatever the market is. Suppose now it's skewed to becoming 80 and 20. It is very important to review the portfolio and see that your actual allocation is brought back to 70-30. This can be done in two ways: by taking 10% out from your equity and putting it to debt, or adding further money in debt to balance it back to 70-30. Why this is very important is that it maintains your actual asset allocation, which is closest to your risk profile. Invariably, when you start investing, you think it is a process of generating returns. Over a period of time, you realize that it is a process of mitigating risk. And the portfolio which is closest to your risk profile gives you the best investment experience. And that is what would have happened when you come to the conclusion of 70-30 to begin with. So when the markets would have fallen, suppose it's gone to 60 and your debt has become 40, it is then important to replenish 10% and bring it back to 70. Now, over a period of time, when you do it periodically and follow your review with a very unemotional rebalance, you will see that your goal achievement will be superior because you are sticking to your plan. And unless you don't rebalance post a review, most of the time the process becomes meaningless. When you look at, I'll give you a very interesting example. Say our hybrid fund is 70, typically the industry's hybrid fund is 70-30, and most of them rebalance every year. The power of increase in returns, because it rebalances every year unemotionally, is pretty substantial. So please never underestimate the power of rebalancing. And if you fixed up a time for review and rebalance, make it mandatory to meet your planner and do the review and rebalance almost unemotionally.
Exactly. But then let's also talk about subcategories within asset classes. So Arun, what type of subcategories are we talking about typically in a very well diversified portfolio? If we have to look at what all would it involve?
Yeah, so when you start with equities, broadly the usual approach would be to look at some exposure to large cap, mid cap, and then small cap. Now how do you decide on this? Broadly, you look at the overall market structure, and then say how is the say you put the top 500 stocks, and then say what is the weightage for each of these large cap, which is the top 100 stocks, and the next 150 stocks is the mid cap, and the remaining stocks are the small cap. So broadly, it would, at least from an Indian context, you will roughly have 70 to 80% in large caps, and then probably 10 to 15% in mid caps, and small caps being 5 to 10. So this is the rough metric that somebody can look at for building a very simple portfolio. The way we kind of do it is slightly different, because what we have seen is within large caps, you have different funds following different investment approaches. So thereby, when you club everything as large caps, we find that within the same category, you have very different approaches being clubbed together. So what we do is we follow something called a 5-finger strategy, which is in a simple way. Essentially, we are saying, hey, can we figure out 5 different investment approaches which have proven to work not just in India but across the world and over a long period of time. This is also fancily called factor investing, where essentially the investment styles we have identified as some fund manager who's more towards the value or the contrarian kind of an orientation. So this is one approach. The second would be like growth but at reasonable prices kind of an approach. The third would be quality, but obviously which is coming at a slightly higher expensive valuation kind of an approach. And the fourth would be your mid and small cap, which is basically saying that the smaller or the smaller sized companies will have a slightly have a slight edge over the long run. Then the last thing would be your global basket. So overall, when you combine value, growth at reasonable price, quality, mid and small cap, and global at 20% each, what we have seen is that inevitably over a cycle. So we've been running this for almost the last 3-4 years. So we've seen that each and every year there is 2 or 3 styles which do well, and then the other 2 styles don't do well. But it's very difficult to figure out which is the exact style which does well, which is the whole idea of asset allocation, that you don't have a precise idea on which asset will do well at what point in time. The same logic we apply here, saying even within the asset class, we do not know exactly which style will do well at what point in time. But if we club together all these styles which have proven to work well over 7 to 10 year cycles, then that intermittent phase where 2 or 3 funds are not doing well because of the style going through the underperformance, we are able to handle it better, because at a portfolio level, the client still has a smoother experience. So overall, this is how we do it. And within that, we pretty much we look at flexi cap funds, where flexi cap or funds where the fund manager is not constrained saying, hey, I have to have compulsorily so much into large cap, so much into mid. Except for the mid and small cap bucket, all the other 4 buckets, we predominantly go for funds where there is not much of a constraint on the fund manager. And if a contrarian fund manager finds an opportunity in whichever segment, he or she is free to do it. So that's how we do it on the equity side. On the debt side, it's fairly simple. We look at, there are only 2 risks to look at: interest rate risk and your credit risk. So we go for super high credit quality funds where at least 80% or more is into AAA oriented papers. And then on the interest rate side, we say duration of not more than 3 years. This becomes our base bucket. If you need some extra kicker on that, say up to 20 to 30% of your fixed income portion, you can put it into some categories like equity savings, where you have some equity component. We don't do credit risk funds, but there's also, you can go slightly longer duration funds to get that extra kicker. But this is completely optional for most beginner investors. I think you keep it really simple to a short term or a low duration, or this banking and PSU or corporate bond. Most of these categories have super high credit quality, and the interest rate risk is limited to less than 3-year duration. So that should be a good enough combination. So this is how we club the diversification part within equity and within debt.
All right. Now, within this asset allocation strategy, Swarup, can you please explain us the difference between active and passive strategies?
It depends on how you approach investing. I think Arun will be better at answering this than me. In the fact that, it's up to the investor. Now, when you look at it at a fund management level, what is perceived to be active and passive style of investing is very different from the investor looking at it from an active or passive style of investing. I mean, when you look at a review and rebalance, according to me, that would be an active way of looking at investing, and that is the right way of looking at it. But my humble request would be to put periodic times to it, and those times should be reasonable enough for the asset class to play out. Now, if you are going to minutely track your equity portfolio on a monthly basis, it's not going to work out. So every asset allocation has a horizon. Like we typically say, equity is 3 years or debt is at least a year or so. Now, review post this to give better returns. Now, some people buy and hold. There is nothing wrong with that. But it gives you that big disadvantage of not rebalancing at times. So depends on the approach. I would be more favorable to the people who review and rebalance at a specific periodic level. That gives a better sustainable process to investing and more scientific approach to approaching the volatility or catching the upside and the downside of the market through a very clinical mathematical approach.
So, Arun, how do you look at it? Because obviously, how can one place their strategies in active or passive way? And also, how can you monitor and adjust your asset allocation over time? Do you need to adjust a client's asset allocation regularly in response to the changing market conditions?
Yeah, so the easiest question is how do we monitor asset allocations over a period? So we have 6-month reviews, whereas Swarup said the broad idea is that how far are you deviating from the original asset allocation that you've decided. Now, some bit of deviation is fine, because automatically, I mean, if you keep your band too tight, so let's say you are at 70% equity, 30% debt, we are okay for a plus or minus 5% kind of a deviation. So let's say your portfolio is at 73% equity, we won't necessarily move 3% back, because net those small deviations are fine. But we have so let's say it goes to more than 5%. So let's say it comes to 76 or say 64, then we might want to rebalance. But broadly, in terms of frequency, there's been a lot of study done globally, and we've also done a lot of work around it. There has not been much of a difference, say, even if you do it 3 months or 6 months or 1 year. Most of the studies across the world have seen that there's hardly any significant differential, and there's no pattern to it. So broadly, we follow, while we do a 6-month review, ideally we want to do those rebalancing activities once a year, unless and until there is a very sharp move within the year. So usually, say, if you are doing it in Jan, there might be years like 2020 where you had a sharp fall of 40%. In those cases, we will want to step in and do some bit of rebalancing. But otherwise, say 90% of the times, it runs on a 1-year schedule. And in a lot of years, you might even see that it's still within the band. So it's not like every year you will be forced to do it. So this keeps your activity at a lower level, so that you are leaving the portfolio untouched for some point in time. And in only rare cases where it is required, you come and rebalance. So it's only in few years where the moves are very dramatic, and usually it's always on the equity side. So that is where you will need to step in between the year and then do some rebalancing activities. So that's how we look at the asset allocation rebalancing part. terms of active versus passive, see, right now we're still heavy on active. So the way we look at passive is that now, because we say passive, we forget what is the underlying that goes behind it. Passive, essentially, you are saying that, hey, a larger sized company will do better than a smaller size company. So what you essentially do is you arrange all the stocks as per size, and you pick the top 100 or pick the top 200. USJ S&P 500 is the top 500 stocks. So net you are saying, hey, this is a rule which says larger the size, the better it is for my returns, and hence so in any environment where your large sized companies have done well, which has been the case for the last 10 years, especially in the US and also in India, you've seen that in the last 5 years. So usually passive tends to do well. But for us, it's yet another style. This approach of larger the better is one more style. So the way we look at it is, hey, larger the better is one style. Smaller the better is one more style, where you say mid and small caps. Higher quality the better is one more style, which you call quality. And lower valuation the better is what you call valuation style. Again, growth, the higher the growth, the better is one more style, which is growth style. So we are not biased towards one particular rule. But this being said, we think at least in the large cap segment, we think passive makes a lot more sense, because a lot of funds have a very high overlap with the index. And given the fact that the expense ratios are also on the higher side, just to compensate for that differential, you will need a significant outperformance on the remaining portion. When we checked, most of the average was only 40% of the portfolios of large cap funds were different from the index. That's also because you have a constrained narrow universe, and there are a lot of stocks which a lot of fund managers don't take. So it's a narrow index, and the overlap is inevitable. So I think it's very hard for a large cap fund manager to outperform on a consistent basis. So in that segment, we are a little more biased towards passive. But on the other end, most of the other segment, we think at least the flexi cap and all these different styles which I was speaking about, we played through active. So it's a combination of both based on the client's preference. So passive is purely large cap. But if a client wants an active portion, we club together these 5 styles and let it run. So we have both the styles available.
All right, last question. Swarup, what are some common mistakes that investors make when it comes to their asset allocation strategies?
Yeah, typically in investing, I don't think mistakes is the right term. It's the approach. I think more often than not, the focus on the outcome is far larger than the process. The ignorance of the risk profile is something which I have also come across. People invariably choose products over the process, and that's where the process gets fundamentally flawed. It's a very simple process. First, identify why you want to invest. That is, fix your goal. That is how you give investing a tangible process. And because of this goal, everything starts working backwards. If you don't know why you want to invest, it's impossible to know where you will invest. But typically, the focus goes more on where to invest. Which is your best product? Is a question which I'm often asked. Do you need that product? Is that product suitable to you? Do you already have products which are similar to that in your portfolio? That question invariably is meaningless. What you should ask yourself is, why do you want to invest? And hence, this is my return expectation. Based on that return expectation, this is the kind of risk I can take, and hence I can invest in a certain type of asset classes. Now you continue doing that to your journey. 9 out of 10, the journey is discussed first before the process. While if the reverse is done, the investment experience can become actually pretty predictable.
All right, that will be all. Thank you so much, Swarup and Arun, for this elaborate discussion on asset allocation and the importance of asset allocation strategies. On that note, we'll take a quick break, and post that we'll be joined by Feroz Aziz, who will be discussing and talking on hybrid mutual funds today.